Hi everyone, and welcome to the next episode of the HeelanHub podcast, the show for small business owners. I'm Dan Heelan, and on today's show, it is me back talking to you today about exactly when you should consider turning yourself from maybe a sole trader or a partnership into a limited company. But firstly, before we get into that, just want to say Happy New Year. I suppose by the time you're listening to this, you've a few weeks into January. Hopefully the New Year's treating you well. Wondering how you're getting on with your New Year's resolutions, if you set any goals or anything else. I think a few years ago, I used to do a kind of a goals show where we talk about like what people were setting. I can't remember if I ever did it on the podcast or was just blogs and other things we did, but there was always this focus on goals and goal setting. I haven't done one of those for a while, but hopefully if you have set some good goals, good luck with those and hope they're going well for you at this early stage of the year. But on today's show, I want to talk about that transition to limited company. The reason I want to do it right now in January is so many of you do it. For us as business accountants, it's our busiest time for people who are inquiring and want to do that. Between now and March, it goes absolutely crazy for people talking about this particular thing. And I want to try and give you as much upfront thoughts as I can about it. And I'm going to link you to a tool. It's a little quiz that you can take to see how strong a percentage based on some of the factors I'm going to talk to today would mean that it's maybe a good idea to investigate going limited. Because the thing with limited companies these days is that there isn't a straight maths answer. Not that's compelling enough, I think. So let's get into it. So then when it comes to a limited company, quite often we spend a lot of our time as business accountants looking at limited companies and saying, why were you a limited company? What made you decide to do this? Because actually you're doing so little turnover that it's going to cost you more money than you're making in profits just to file the accounts each year. Now, I've done loads of other shows talking to you about why you're probably going to need an accountant to file your accounts. I meet a couple of people a year probably that have given it a go themselves. They're either maybe accountants in a commercial sense and they know enough and they've been able to scam the system effectively to get themselves some software. But the other side of people that I would meet would normally use the free company's house tool, which is actually ending in 2026. I think it's around March. So a lot of people, they're going to now have to pay to have accounts filed. So it doesn't make a lot of sense if you're not making a lot of profit. But there are scenarios, as we're going to talk about, where that still might be the case. You still might be forced into trading as a limited company. But in the old days, if we go back to probably, I don't know, maybe 2009, 10, all the way to around 2015, it was a really clear look at if you did more than even, I remember doing examples for people at £16,000 profit, it made complete sense to transition into a limited company and they would still save even after accountancy fees. And there was also back then, there was a flat rate VAT scheme, which exists now, but it doesn't have this limited cost trader rule it had. So you were able to transition somebody to a limited company, VAT register them on the flat rate scheme. Dividends back then didn't have any tax bill associated with them in the basic rate of tax, which is the bit that's currently, like if you took now today's figures under about £50,000, we pay 10.75% on dividends. Back then, with the way the system worked, you didn't pay any, effectively, you didn't hand over any tax. There was this weird tax credit system that existed, but the ultimate result was you didn't pay any tax. It was amazingly good. And over the years, it's just been absolutely eroded to the point now that several things I think have to exist for you to do it. Now, if you're thinking, well, why should I be limited then? Well, there are a ton of reasons, and we're going to recap on some of those as we talk about the show. And just to give you some, I suppose, confidence that limiteds aren't a dying breed, is the vast majority of our clients are limited companies. Once you start earning some good profits in the business, there's so many reasons that make this a good idea. What isn't a good idea now is to start number crunching it on any grand scale. And that sounds really weird from an accountant that spent his life doing that. Because what happens now is if I was to bring up a £45,000 example of a sole trader and a limited company, and I just showed you the two together, you're going to look at that and go, I'm just going to be limited. But the chances are that you'd probably be better off in a vast majority of scenarios in the actual practical application of it and done well being a limited company. Now I'm going to explain some of why that would be the case, but that £45,000 profit mark, I think, is a good marker to hit. It's not an exact science, but to me in 2026, that's the figure. If you Google it online, you'll see people talking about 30,000. Pops up quite a lot. I think AI shows you 30,000 a lot. It's just historically that was a good limit. Even I was talking about 30 grand a few years ago as being a good figure, but the mathematics of it's moved. But even if I did £45,000 example, the problem with the comparisons for a limited company versus sole trader is if I show you as a one person owner director taking all of the same money out, and it presumes that you're going to take it all out in 1 year, versus you as a sole trader, it's going to show a better result. And the reason being is that sole trader national insurance is so cheap now, and you pay 2 tax bills of a limited company. You pay a corporation tax bill, which is the company's tax bill. You pay that once a year. And you, when you take money out, depending on how much you take, then will probably pay a personal tax bill in your personal tax return. It's just the personal tax bill is usually lower than the company tax bill because of the way it works. So yeah, so you combine the 2 tax bills versus the 1 tax bill of the sole trader. Now, the tax bill of the sole trader, they might have to pay several times a year. They might have to pay in January and July, but I'm going to count that as it's still 1 tax bill. You're just paying it a couple of times a year. This other one, you're paying the corporation tax bill once a year, and you're paying your personal tax bill probably twice if you're being successful, but they're a lot lower, as we're going to talk about, than the sole trader. So if I showed those two, and the problem with these scenarios is that they always presume that you're taking, when you do this just on a spreadsheet, that you're taking all of the money straight out of the company, and it won't look good. But you're not. You're generally not. It's not how it works. As a sole trader, you're taxed on whatever. It doesn't matter what you do with the money. If that's the profit on paper, you're taxed on that profit. It doesn't matter whether you used it, what you did with it. With a limited company, you're in control of it. So if you think about it from a sole trader point of view, you could be paying, if your profits go over £50,000, you'll be paying 40% tax, and you've got national insurance as well. With a limited company, if the company itself has no national insurance, but it does have up to 25%, so at £50,000 only, if it started to go over it, you start paying over, let's just call it 20%. It's somewhere between 19 and 25%. And we've done other shows, and I think I've got a couple coming up where I'm going to talk a bit more about some of the traps around trying to get your head around what that figure really is. But let's just say the maximum tax you would pay in the company is 25%. But then you're taxed again when you take the money out. But if you didn't need the money, the whole scenario changes. You can do a lot with the money that's in the company and not touch it personally, which really changes that scenario. And if you had that spreadsheet example where it's just a comparison of what the tax rates are, it just presumes you're taking it all out, and it's just wrong, because you won't. And you just won't. You'll want to do it. Some people will. And if it is you, if you're like, no, I need every single penny from a limited company, I've seen so many people get into trouble with that. And I think that that is where you've really got to consider whether a limited company is right for you. But if you're like, no, it's a business, I'm going to be taking what I need to live on, yes, but I want to grow the business, I want to invest, I might want to do other stuff with it, then a limited company just starts to move apart. So there's a couple of scenarios where it's going to be a good idea, and I'm going to touch on those in more detail. But those basics aside, let's talk about then why you would be a limited company. Well, the first one is that limited, just as a recap, limited liability. You're generally protected personally. So if anything goes wrong, normally it's only the company's stuff that's up for grabs. It's not your house or anything like that. Now, there are exceptions to that. So, for example, if you go for bank lending, they'll often get you to sign what's known as a PG, a personal guarantee, that can look through the company and go for it. Sometimes, if HMRC have got certain powers to look at certain taxes and say, we want to make you also jointly liable for this tax. It's very rare, though. Normally, I'll give you an example. There's a couple of companies right now that are clients of ours that are going through liquidation. They've had a really bad trading time. Well, one of them particularly, one of their customers has not paid them a big sum of money. They now do not have the money to pay any of their bills or the tax bills that they've got, and they can't trade anymore. Now, they've done nothing wrong. That is very likely to now go through liquidation. The tax office will not get paid, and then will start again fresh. Now, not ideal for the tax office and the government, obviously, but that's the nature of business. There's risk and reward. Now, if they've done everything right, that limited liability is going to stop them from losing their house or anything like that. If that was a sole trader doing that, then the tax office could put charge on their house, could force them to sell their house. They've got lots of powers around collection. So really important, that limited liability. So for a lot of people, that is a reason enough to want to be limited. But I think you do have to look for some of the bigger reasons. We talked about tax as one. So tax savings is quite a large motivator. And actually, there's a lot of things you can do. Like I've written a guide. We have a methodology here in the business called the tax funnel, where we work with clients to try and work out what's the best way to squeeze all of the money you possibly could in tax deductions to make sure you're only paying the right amount of tax, which is therefore going to be the lowest amount that is legally possible, depending on what people want to do, depending on what expenses they've got. And there's a lot of limited company only tax deductions that are available. Things like, you would have heard me potentially, if you're listening to this as a limited company only already, you would have heard me talk about maybe trivial benefits, or the way some of the annual staff function parties and allowances work. There's some limited company only rules. There's R&D tax credits, research and development tax credits. It's only a limited company rule. So there is a lot of tax reasons to do it. There's also the point that you pay, because of the way that the tax bill's done, like I already said, where you pay two bills, but your personal tax bill is lower. The main tax bill for the company is only paid once a year until you reach about 1.5 million profit. There are rules that bring that 1.5 limit down. If you've got multiple companies, that limit starts to get reduced. But for a lot of you, it's going to be a long time before you start paying corporation tax, if ever, in more. And that's profit, by the way, 1.5 million profit. It's going to be a long time before you start paying in quarterly installments, which is what happens after there. So you've got that one big tax bill. Now, a sole trader pays twice a year. Those, that particularly in that first year, you're always out about, I always think about half a year to a year's worth of tax. Let's call it half a year, because when you earn over £1,000 of, when you have to pay, over £1,000 of tax on a tax bill, they generally ask you for payments on account. And we've done other shows talking about this, but you have to pay tax, not quite upfront, but it feels like upfront. It certainly feels like upfront the first time you get the tax bill, and it can be quite significant. So if we took that example, I said to you about £45,000 profit and compared the two, and compared the cash flow of when you paid the tax bill, you would be much better off being a limited company, because in that first year that's going to happen, the cash flow of being a sole trader and having to part with that cash is worse. And I think that's one of the key reasons. It's not necessarily the tax savings, it's the cash flow savings, and then what you could potentially do if you're, utilizing everything you should be using. And it's really weird if you just looked at the two, you start at a position where, as we said, the sole trader one's going to look slightly better. But if you were able to add in all these extra bits and you factored in the cash flow, the payments, it starts to move much better into being a limited company. So the tax, absolutely, in the right circumstances, and we're going to talk about a few combos of those, will be better. Not always, but the cash flow benefits, if you're doing well, will be better, particularly in that first year. So you're normally looking at a combo of those things. And when we start looking at, can you bring significant others that you share household finances? Do we have adult children that want to work in the business? Do we have other people with tax allowances that want to be part of the business and work with the business, and we can pay them? There's lots of really good ways. Do you want to pay into a pension? Do you want to eventually invest in property? Like, there's a lot of combinations that make a limited company a lot more attractive. But if you're in the scenario where you just want it and you want to take every penny and save the most amount of tax, it's unlikely to be for you. I would say in 2026, I think you will just find it hard work to manage and frustrating. You'd be better off with a sole trader, because it's easier to file. There's a free tool. You can do your tax return. You might have to do the new Making Tax Digital rules if you're doing well, or if you're doing over £50,000 turnover in a year, you're going to have to eventually be into those rules, and that means filing quarterly, but that's fine. You would have to get yourself into some software. But if you're not in there yet, or you're a new business, you've got a bit of time, you're on the free tool, filing once a year. That's quite nice. There's not a lot going on there, and all the money's yours. You just have to worry about paying your tax, and that's it. But if you are worried about the liability, like we say, then going limited is a big indicator. So for me, one of the real key signs of exactly when you would go limited is if you're going to become VAT registered. I think that's a massive one for looking to move into a limited company, for the reasons we're saying, those liability. And if we're taking liability as a reason to say, when should we be? Then also I think we should be looking at when you'll start to employ people, because right now there's some big changes to employment rights that are happening all over the place. And it's really hard now. It's always been very easy to slip up and end up with an employment claim. I've seen lots of clients get themselves in a lot of trouble for not handling their human resources, their HR procedures well. It's a big risk to a growing company. So, and as a limited company, at least it's restricted to the company rather than you. So if you start employing people, I think that's a good trigger as to say exactly when. And also, if you become VAT registered for the reasons we were saying, they're two big ones. And tax, I would say, is almost the third one at this point, of looking at, okay, well, if I'm reaching a scenario where it makes sense for tax and there are opportunities, then let's do it. Now, on top of that, there's a couple of real good reasons and triggers, I would say, to look at going limited. There are some cons, though, as we said: the cost of having it, the cost of filing it. You've got extra record keeping. I would argue your record keeping needs to be better than it is as a sole trader. Even under Making Tax Digital, the new sole trader rules, yes, you'll have to be digital and submit, but it still really is a case if you can do it on what they call the cash basis for many people, which is going to be, you just add up what comes in and what goes out and categorize it and submit that. Limited companies are full accounting rules. They're called FRS. FRS 102 is the normal accounting standard. Often Section 1A is what people would do. But you have to know knowledge of that. You have to be able to draw up a balance sheet and think about revenue recognition and timing and prepayments and accruals, and these like words you may have come across. that are in the realm of what accountants do every day. Their need of the limited company is so different to doing a sole trade that the con of it is you're basically going to end up paying somebody to do it for you. So there's that. Your data's on the public record also, so people can see certain data about you. Quite often, whenever I have the rare chance where it's not one of my team, it's me on a call where somebody's phoning in to talk to us. And quite often I already know their limited company before they're talking to me. And they're like, how'd you know that? And I was like, because you give me a few key pieces of data and I can find that on Companies House. So there is there. And if you decide that you want to close the limited company down, there's also quite a lot going on there. So you've just got to bear in mind that there are these extra parts and the public data, so that it's not all fun and games. It really is. And it's funny because I did a video similar to this on our YouTube channel over at Heelan Associates, and there's a couple of comments that really highlighted this, which I think was great insight from them, saying that, closing the limited company down was the thing they hadn't realised. So it really is important, and it is important to do. And you get a lot of people every year that are talking to us. We've had a couple this month where they're like, my filing deadline is in a week and a half. Can you do the limited company accounts? Well, I can't. I mean, by the time we onboard you, do our professional regulations, get to know you, get all the filing codes we need, it's just not the time to do it. So it really is something you can't leave to the last minute as well, because it's a very hefty job to actually do. Even if you've done next to nothing, there's still a base level of accounts that need doing and corporation tax returns. These things are all digitally produced now, digitally tagged as they're known, and transmitted. So it's a massive piece of work versus a free tool. Unless you're inside Making Tax Digital, then you'd need some software, but even then it's not particularly expensive, and it's relatively easy to keep your records. So just bear those cons in mind. So then let's just flip back. I know we're jumping around all over the place here, but this is why I like this format. I can just ramble between all the various points. I just want to give you a bit of a balanced picture of limited. So when we're talking about exactly when to go limited, I think we've said that you need a combination of factors to be in play. So for me, if the kind of combinations I would want to see is, we don't want to drain the company of every pound. We're probably in the £45,000 plus scenario of profit, or, and this is a big or, you have a main job and a side hustle. Your main job plus the profits from this side hustle are going to take you into the higher rate of tax. At that point, you could have a lot less than £45,000 profit in the sole trade and it be worth it. So for example, I saw one recently where the person earned £60,000 in their main job. They're already in the higher rate of tax. Every pound they're going to earn profit in their sole trade is now going to lose 40p out of it, just because of the fact that it's higher rate tax, whether they touch the money or not. They didn't need to touch the money. They just wanted to reinvest it in the business. Being a limited company instantly saved them a lot of money. They had a 10 grand profit. So if you imagine, that would have been a £4,000 tax bill personally, or we leave it in the company and the max we're going to pay is £2,500. Under £50,000, we're actually only going to pay 19%. So our tax bill could have been £4 grand or £1,900. Even if you factor in accountancy costs, that's still worth doing. And actually, with what she wanted to do, she could even reduce that tax bill by doing certain things in the company as well, and contributing to pensions and other things that brought that right down. So it's like a money box, as sometimes we refer to it. Side hustle money boxing is the term I'll often use for it. They can be really powerful. So there's a good sort of scenario of doing it. If you're finding that problem where you're already higher rate taxpayer and your side hustle's causing you money, that's one scenario. I think if it's your main deal and you're earning over £45,000 profit, you don't want to take every single penny out of it. Then that's a good level to look at it. I think that if you want to, and these are all, of course, usual disclaimer, dependent on your circumstances, do your own research, results aren't guaranteed, all that kind of stuff. But these are the general scenarios we see work well with our own clients. You would also be looking at, have we got a significant other we could bring in? Because what the limited company allows you to do quite often, if it's set up right, is you might be able to use some of the other person's allowances. Stereotypical example, this is husband and wife. One of them's the primary child carer, has no other income. They've got 12.5 grand a year personal allowance sitting there doing nothing, plus all their basic rate band. So that gives them, with their personal allowance, up to around £50,000 a year that could be utilised for tax planning purposes. It is super powerful if you can split the income. And by split, I mean maybe you paid them some salary to do some admin work in the business or some social media. There's lots of stuff that your other half could potentially do for their salary. And also there's a way, often if you set the share structure up right, if you're paying dividends, the profits from the company to the shareholders, normally the shareholders it might be that you want to give your significant other some shares, maybe pay them some dividends. It can work really, really well, particularly if you start doing really well Because if you get up towards 100,000 and you're on your own, you can start losing personal allowances. That 12.5 grand starts to disappear. You end up with tax-free childcare starting to disappear. There are lots of things that start to just fall off a cliff at 100 grand plus. And it's why you might often hear that for some people, the rate between 100 and 125k, for example, could be in the region of 60 odd % tax rate if you factor in all the things you're losing and maybe student loans and things like this. So really horrible. But if you can split that between two of you and you have 50 each, the picture is massively different. So that's a really good scenario where it works well as well. So there are a couple of common ones, but I think the risk, and then as we said, risk is a big one. So I would say that if you're in an area of risk, that is a really good time. VAT registered to start and employing people. Now, we mentioned about the cash flow of it. I think as well, a couple of other things that are worth bearing in mind is sometimes you don't actually have a choice. And what I mean by that is that sometimes you will go to work with someone, and I've spoken to several people even in the last month that are in this situation. They've said, I want to work for you. And they said, cool, you need to be a limited company. Because the person they're working for believes that they need that other person to be a company. Most of the time it's complete rubbish, but they think it adds to the fact to make sure that there's a real clear line that they're a freelancer and not an employee. Now, there's some truth in that. I'm not going to bore you with the technical detail. There is some truth to that argument, but it isn't. I mean, it absolutely isn't the case that just because they're a limited company, they'll be immune from ever being accused of employing the person, which is often what people are trying to get around. So sometimes you see this forced limited company, or you're doing it across border. And so say you're working with a company in the EU and they need to be able to prove for VAT reasons or their own internal kind of guidelines. They're like, well, we only deal with limited companies because we know you're in business in your own right and it doesn't cause us a problem. So there's lots of practical reasons why you might just be forced to do it. So there's some thoughts anyway. I just wanted to come on at this time of year and talk about it. Let's do the opposite though. Let's do the opposite. Where wouldn't I want you to do it? In a common everyday scenario, obviously not your scenario, but if this is you, think about it. I would say if you're really early stage and you're just testing the water, don't immediately boot one up. I think if you're looking to do it purely for tax savings and you're draining every penny, don't do it. You'll find it more frustrating, I think, than anything else. If you can't separate business and personal expenses, that tends to be a bad idea as well because you can get in a mess. If you don't want to invest in accountants to help you, mess, because if you're already in these scenarios we're talking about, it just can be a mess. And I think that if that's you, just stay sole trade, keep it easy. It's really not that big a difference because for all the clever things that I'm talking about in terms of tax saving that are possible, require thought, require legal things to be in place, require structure, and normally require investment from you in professionals to put in place. Which is why quite often when people are like, shall I go start up a common question? Shall I go start up a entity abroad? I'm going to go start up a Dubai company or somewhere in the Cayman Islands. Like, can we do all that? It's like, well, you could do, but apart from the multiple tax problems with that, there's also the cost. And the minute people start looking at the cost of these things, they immediately discount it. And I'd say the limited is your first on-ramp for that kind of feeling. Like, do you want to commit the cost to do this thing and use this thing properly? Because if you don't bother, just stay. Our sole trader flexibility and tax rates in the UK at the moment is probably as good as I've seen them for the time that I've been, and I was self-employed before I started being an accountant, and I think I wish I'd had what we've got now then, like in terms of the rates of national insurance and how the rules work. I won't bore you with that, but there's two different ways of doing your personal tax return. There's the cash basis and the accrual basis, or the traditional method as it's now being called on HMRC's site. That cash basis is so easy from a record keeping point of view that it's just great. So just bear these things in mind. We've probably got the best self-employed system we've had for some time. So low regulation, so easy to boot up, so easy to close down. So really think about it. But on the other hand, we save a lot of people a lot of money using limited companies in the right circumstances. So there we go. Hopefully that's given you a bit of food for thought. Now, if you're thinking, I did say at the beginning that I have a quiz that will give you this. If you go to should I be Ltd, so should I be limited, should I be Ltd.scoreapp.com, score app, you'll be able to find it there. There's also a video on YouTube where I go in a bit more detail with visuals on this. So if for some reason that app, Score app, doesn't work from my description, if you just go to find the video, it's called Exactly When to Go Limited Company on our YouTube channel. You can see in the description there's another link for it, and I shall put it in the show notes as well. You better go there. And it's about 18 questions, takes on average 1 minute 20 seconds according to the data we've got to fill out, and it will give you a score that says the percentage of how likely you would be to benefit from a limited company. It's very hard to achieve the very high scores. So if you're getting anything over 50%, there's a solid chance it's worth research, and if it's lower than that, it will tell you. I think if you get lower than 40%, it will say maybe this isn't right. But because it is based on generic scenarios, doesn't mean that it still couldn't benefit you, and it doesn't know where you are in your growth journey and all the rest of it. So if you wanted a more bespoke look at your scenario, you can contact my team, book a discovery call, and we can talk to you about the various options of how we might be able to support that decision for you. But there you go. So go and have a look at that score app, and it will give you a good score. So then, if you have found value from today's show, please do subscribe via your favourite app so you don't miss an episode. We're currently putting these out on a side YouTube channel at HeelanHub, so you can see me ramble into camera doing this instead. But that's quite cool because you can comment in there, and once a week I'll go in there and answer what I can. And that's always nice, because one of the downsides to podcasting is that it's me rambling at a wall on a Sunday, and that's it. I can't see you, can't interact with you. So it's really cool. So please do, if you've got any questions, comments, anything else, go to that YouTube channel and follow us there. But yeah, please do subscribe via your app. I know most of you get this through Spotify, so make sure you're in there. If you do have 2 seconds to drop us a review on there, obviously helps the visibility as well of anybody that's coming across the show for the first time. That'd be really appreciated. For more direct business insight and tax tips and more of me and my team, be sure to connect with us on all of the social media channels, including, of course, LinkedIn, Instagram, YouTube, Facebook, Twitter, and TikTok. We've been a bit slow recently at putting out some of the other socials. YouTube is where we concentrate most of our time, but there's tons of hours of content across all those channels that you can keep up to date with. You can also sign up to our 2-weekly HeelanHub Herald, which contains even more business insight and tax tips. And you can do that by going to our website, HeelanAssociates.co.uk, scrolling around, and you will get a little box to put in your email and be signed up. That's an email newsletter with a lot of this kind of information every 2 weeks. If you do want to get a fantastic deal on, we talk about software a lot, and if you've listened to me for any time, I talk about accounting software frequently. For me, the market leader is Xero with an X, that's Xero. If you go to HeelanAssociates.co.uk/Xero, all lowercase, you'll get a great deal. I think at the time recording this video, it's something like 95% off, but it does change for 6 months, which is massive. So go give that a go. If you want to be, and I should say disclaimer, we obviously get a little kickback off that, and you get a great deal. Everyone's a winner, so please do help support yourself and us by doing that. If you want to get in touch about the podcast, please do so at info@HeelanAssociates.co.uk. And that's it. So have a profitable and tax efficient week, and I'll see you in the next one.